Hi, Jason.
Yep.
Obviously, you've got lots of money to spare because you can go around flipping coins. It's about flipping coins.
Yeah, it's
This
about
is
flipping
complex.
coins.
How are you going to explain this in,
Well,
in a sound
I
bite?
should have brought a quarter with me, I
Right.
guess, but
budgets are really tight around here, and we didn't have a quarter.
Come on, here we go. So, in the 18th century, two great mathematicians, Nicholas and Daniel Bernoulli, proposed what became known as the St. Petersburg paradox. And basically the way it works is we're going to flip a coin, and if it comes up heads, the game is over, but you win. And the amount you win doubles each time we flip the coin. So the expected value of playing the game is infinite because we could get tails, 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 and the amount of money you would win on heads keeps piling up as the game progresses. But you could also get heads very early in the game. So the question is, how much do you want to pay to participate in this game? And a mathematician says, well, you should pay almost any price. You should pay an infinite price because you could win all the money in the world if you keep playing long enough. But most people will only pay about 20 bucks to play a game where the amount of money doubles each time. So the key thing with an IPO of a high growth company like Facebook is the expected growth is monstrous. I mean, this company could be, you know, Google and Apple combined a few years down the road, or not. So it's the same kind of high stakes gamble you get in the St. Petersburg paradox.
Because we have seen the valuations of this IPO. I mean, there's been an incredibly broad range.
Yeah, absolutely. And, you know, if Facebook continues growing over the next 10 years the same way it's grown over the last year, it'll have 22 billion users 10 years from now, which is 3 times the number of people on the planet
I was going to get to that. I was going to get to that bit.
So
maybe my cat will be using it.
Right, so you have to assume
Already
that
is,
at some point your growth rate is going to come down. So the question is, how much are you willing to pay for that high level of growth today? And you have to allow a big margin of error in those future projections, because when a growth rate is that steep, the slightest difference really narrows the fan in the future.
How does the average investor even, you know, winnow through this to figure out to get in, to not get in, and what price?
Well, I mean, you're not going to have any choice because the price is going to be what the price is.
Whether when it goes to market, though, is there a point at which people should stop buying? I mean, do we have any sense of that yet?
Well, you know, if it's highly unlikely that Facebook is going to come out priced any less than the buzz already has it, which is somewhere in the 100 billion plus range. And at that price, you really have to bet that Facebook's coming 10 years are going to be a lot better than Google's past 10 years. And they might be, or they might not be.
So this is interesting. Why don't people stick with the so-called discounted cash flow? That the dollar in 10 years' time is worth nothing like what a dollar is today. In fact, a dollar today is worth, and especially with a high-risk proposition like this, a dollar today is worth probably about 99 cents more than a dollar in 10 years' time, especially from Facebook.
Well, with high-growth companies, there's a pretty good argument to be made that for most people, they should be skeptical, just as you described, because
Prudence.
I'm going to call it skeptical, because the slight difference in that when a growth rate is huge and you trim it by a little bit, the value today drops enormously. And that's what people really need to bear in mind.
Yeah, they do. There's a formula for that, but I won't go into it, and I happen to know it, but it does make huge differences. It's always a pleasure. You can read more on that and study up. Saturday morning studying with Jason Zweig.